My apologies. Jerry, can we do that one more time? Jerry Abrahams.
Still here.
Thank you. Commissioner Dahm. Phil DeFranzo.
Here.
Timothy Hodges, I think, was unable to join us this morning. Catherine McKinnon.
Here.
Commissioner Perez. Franklin Perry is unable to join us this morning as well. Chelsea Ross.
Here.
Sarah Sanders.
Here.
We do have a quorum in attendance for the meeting.
Thank you. And good morning, everyone. What a beautiful day. It's going up to 76 degrees today here in Hartford. Lovely. And first item on the agenda is amending the resolution for the revolving loan warehousing facility. So over to Hazim.
Thank you, Sarah. Good morning again, everybody. Before you is a resolution to amend a resolution approved by the board in February 2022. At the March 2021 meeting, the board authorized CHFA to procure a credit line totaling $75 million to preserve single-family loan prepayments, a precious CHFA resource for future loan originations. At the February 2022 meeting, the board authorized CHFA to procure a credit line totaling, again, $75 million to warehouse and help facilitate the timing between purchasing loans from lenders and pledging mortgage-backed securities to the bond program. Due to the rise in interest rate, CHFA has seen a drop in loan prepayments and an increase in loan production. In light of this development, CHFA needs additional warehouse capacity to accommodate its growing pipeline and is requesting the board to approve the amendment, which would increase the total warehouse facility to $150 million and let the existing loan prepayment credit line expires. I'll be happy to answer any questions that the committee may have regarding the action item.
Hazim, it's Jerry. I understand the purpose of the warehouse loan and understand why prepayments would fall. So it all makes sense. I'm just a little confused in my mind. If you would just explain a little more further why we need a credit line for single-family loan prepayments. Just what's the mechanics of that?
So when we presented that resolution, the idea was we had loan prepayments, and for us to preserve it, we could do two things. One would be to leave the loan prepayments where it was at, which was in the recoveries account, and then we could decide whether or not we would like to make the prepayments into new loans. However, during that holding period, we would continue to pay interest on the bonds.
Got it. Okay.
So the idea of entering into a new facility from the IRS standpoint, we are incurring new debt to repay the old debt. That provided us the mechanism to reduce our negative carry. So that was part of the reason. And if you remember, and then you turn back the clock, in 2021, reinvestment rate was very, very low. And we were experiencing negative carry. And at the time, we mentioned to the board that it did not make any sense for us to issue refunding bonds or another bond to take out the old bond. And using a credit line, it would provide CHFA more flexibility.
So we used the credit line to essentially pay debt service on the old bonds while we recycle the prepayment.
Right. So it's not paying debt service. Essentially, what we did, we used the credit line to acquire the loan prepayment. So effectively, you just have another debt taking out the old debt with the new debt incurring or charging a lower interest cost.
Used to acquire the prepayment.
Correct.
But
so say that right now we had bonds outstanding 100 million, you have 10 million of prepayments, you continue to pay 100 million of the outstanding bonds, say that the interest rate was say 4%. You
Yep.
go into a credit facility, the facility is charging 1% again, based on what was occurring back in 2021, because you're paying based on the short end of the curve. So what you do,
Oh,
you
yeah.
borrow 10 million and you pay 1%, the 10 million will pay off the existing bond. So now the outstanding bond becomes 90 million. But in terms of total debt, you still have 100 million. It's just that now is 190 million on the long end and 10 million on the short end.
Under the liquidity facility.
Correct.
Okay. Thank you.
Commissioner Perez, you have a question?
Yes, I do. I understand the purpose of the warehouse and lines and that kind of stuff, but my question is, do we ever pay it down? I mean, does it always have an average balance?
Yes, we do pay down. So effectively, when loans becomes so just to make sure that I know which credit line you're referring to. For the loan prepayments, once the outstanding bond has been taken out by the credit facility, and then when we are ready to convert the loan prepayments into new loans, when we issue the new tax-exempt bonds, it will pay off the credit facility. So that's how we've been doing it. And we did it this year. So we did it a few times where we had loan prepayments from the prior year that we carried over into 2023. And as we saw production went up, we didn't have enough tax-exempt capacity to issue tax-exempt bonds. So what we did was we did utilize. So that's always been our plan, to preserve and then to utilize when it makes sense. So that's on the loan prepayments. On the loan warehouse, we also do it, and that happens on a monthly basis. So what happens is, as we buy loans from lenders, because lenders do table funding, as those loans then gets pulled into securities, when the securities, mortgage-backed securities, are ready to be delivered to CHFA, when we get them, we will then use tax-exempt bond proceeds from a sale that we just conducted. So for example, we did issue back in August, the 2023 Series B, close to 150 million. As we get them, we would then withdraw from that account to then pay off the credit line warehouse facility. And then we do it all over back again.
Right, so it never becomes evergreen when they call in the industry evergreen, meaning that it's not a permanent balance that's always there.
I wouldn't
Because
say
it'll make sense to finance that balance at some point permanently, you know?
right. So again, this is the way we are looking at it. This is just more of an operating line to just borrow when we need it, and then we would.
I understand what it's supposed to be. I'm trying to figure out that we are using it the way we're supposed to be.
Okay, understood.
You know? All right, thank you. And what you're saying is you are using it the way we're supposed to be, right? Meaning
Yes.
that there should not be like a permanent
No.
20 million, 5 million, whatever the number may be, has to use a number there
Right.
that
Correct.
no matter what I look at is always going to have it there because it's become, for whatever reason, it's become a permanent debt.
No.
In a short-term vehicle.
Correct.
Okay.
Yeah. So from CHFA, I just want to make it clear that from our view, is all about managing liquidity. There is no point to borrow if you have the liquidity. So this is more about just making sure that we have sufficient liquidity to ensure that we continue to fund production. Lenders can continue to deliver loans to CHFA, and then they are taken out. And then we're just trying to manage that timing.
So why the need to increase the line so much? Because we started with 75 million, right?
Yeah,
then,
yeah. So if you look at the memo,
because mortgages in general are down, loans are down everywhere. I realize that hard times we become it. I was going to say, I realize that hard times we become a lender of preference because, we have better rates.
Right. So I'm going to touch on it when I present the 2024 budget, but essentially you have a confluence of things happening. Commissioner, you mentioned about the interest rate and the fact that our loan is more in demand today, but also the fact that the secondary market or the wholesale market is not really efficient right now. So effectively, you have lenders that do this for a living, and then they don't themselves have an outlet to deliver loans because the way interest rate is currently priced. So that other side of the business, it is not efficient. So what's happening is lenders, if they want to continue to originate, they are now forced to basically offer CHFA loans.
I got it because in my mind I'm going like, I can understand there's a bigger value, but if we pay it off as we refinance it and we've been doing bond sales on a regular basis, then the line should not ever, reach its max,
Correct.
unless you have some sort of unusual thing happening like in this market where all of a sudden your value went up so much more higher that you need time to catch up.
Yeah, this is solely timing.
Okay. Again, I was just making sure because I know how it's supposed to work, but in my years as a banker and then now as a commissioner, there's been a lot of evergreen lines that I've come across.
Right. No.
Which I'm not saying the CHFA is one. I'm not saying that,
Yeah.
Okay, thank you.
Just a couple comments. I mean, looking at the memo, I was kind of surprised. I didn't realize production had basically doubled. That's amazing. I had actually was under the impression we were having problems with single family with our clients being able to win bids and so forth. But this is great. I see that. I guess that somehow that escaped me. But one of my questions, Hazim, is I know this whole warehousing line was a new strategy for CHFA back in 21. I'm trying to remember how you did this previously, but at that time, I believe some of this was more efficient, a lower cost of funding because short-term rates were so low. Of course, short-term rates are much higher now. Is this still the best strategy? I assume it is, but
yeah, it is. So what we did previously, we would issue short-term bonds, and that's been the go-to. But when interest rate remained low for a long period of time, financial institutions became more, I should say, accommodating in terms of offering clients costs that's more palatable than issuing bonds. So that's the gist of it. So when it comes to the line, again, the key here is you pay if you use it kind of thing. So that to us is why the line is more desirable, because we just don't know, and as we continue to see production and especially home buyers taking advantage of the time to own program, we expect that we will be in this mode for a while until something else occurs in the market.
okay, any other questions? May I have a motion?
I'll move.
Move it. Second.
Second from Kathy. Any more discussion or questions from anyone? Okay, roll call vote.
Jerry Abrahams,
Aye.
Commissioner Dawn,
Aye.
thank you. Phil DeFranco,
Aye.
Catherine McKinnon,
Aye.
Commissioner Perez,
Yes.
Chelsea Ross,
Yes.
Sarah Sanders.
Aye.
The vote passes unanimously.
Okay, our next item is a report on the 2003 Series C bond issue that's done by Wells Fargo.
Okay. I have my memo recapping fairly quickly regarding what transpired when we sold the bond. But here with me this morning is Nick Fleur representing Wells Fargo. So he's going to tell all the good things that occurred on that day. So Nick, why don't you
Well,
you
spoiled my surprise, Azim, but this is a very good story. I did circulate to the board a kind of post pricing book that I will make reference to a few of the charts in there, which kind of summarize both the orders and the successes of pricing that day. But just to give a quick overview on yeah, sorry.
Lorraine, can you move the page? So you just tell Lorraine which page.
Oh, great. Yeah. So Lorraine, just maybe go to first to page 6. So on the bottom there, you can see that, well, you can almost see, at least on our screen, that the total size was around 52 million of bonds. That was comprised of, really a small amount of what we call traditional serial and term bonds. Roughly call it 16 million of serials and terms. We did have a short-term sort of mandatory tender bond. That was the $36 million bond that was really kind of a 3-year tender bond. So I think the hope was when we initially went out with this small number of bonds, maybe we could get a very good, robust retail response. But let's, Lorraine, if you move over to page 10, just in terms of the economic backdrop, I think everybody's familiar that obviously, as you can see on that upper left-hand side there, we've had, 11 Fed rate increases dating back to March of last year. Obviously, that's caused a significant uptick in interest rates. We've seen a lot of volatility. I think we are hopefully nearing the end of those Fed rate hikes. That is kind of depicted over on the right-hand side at the top there in terms of the market's expectations, in terms of, where are Fed rates going in the future. And you can see that, the market does feel that we're really near the top of those rate increases. The interesting thing, if you flip over to the next page, Lorraine, is just how much rates have increased since CHFA was last in the market. You can see there again on the upper left-hand side that really since the 2023 B issue, both the tax-exempt index, which is MMD, has gone up by, call it, 68 basis points. Versus the Treasury market has gone up by 70 basis points. So almost, the market's moved pretty much in tandem because that, the tax exempt rates have moved equally with taxable rates. Ratios, which are the benefit that tax exemption provides relative to taxables, that benefit is not as great as it was back with the 2000 B issue, and that's kind of depicted over on the right-hand side there at the top. Ratios have increased, meaning that the value of tax exemption isn't as great. The good story, as Hazim hinted at, is if you look at these charts, these kind of heat map charts on the bottom of the page there, and you can see that just by the very colors that are depicted there, you can see that the market, and again, MMD is kind of our proxy for the tax-exempt market. Tax-exempt market has been moving arguably the wrong way for a very long time here, dating back to, this chart goes back to mid-September. That did turn around. Again, we priced on the 11th. You can see there, we started pre-marketing the CHFA issue on the 10th. Unfortunately, I would say that, a lot of this lift to the market was unfortunately, the Hamas, Gaza, Israel conflict over that weekend before caused a pretty massive flight to quality. As we often will see in global, when global tensions are high, investors flock to safety, flock to treasuries, flock to U.S., sort of fixed income that are seen as safe. So that gave us a really nice lift in the market. So we started marketing on the 10th. You can see there that rates at the short end were, down, call it 8 basis points, 9 at the long end. We were able to, on that basis, adjust in the retail order period. And I'll just, why don't we flip forward, Lorraine, to page 15. This just kind of tells the story. There were a number of other issues in the market. Actually, it's the page just before this, Lorraine. The Indiana housing, next one. Indiana housing was in the market the same day as us. You can see obviously down at the long end that we were roughly 10 basis points through Indiana. They were 520, we were 510 in the 30-year space. And on the rest of this page and the following page, you can see that CHFA was able to effectively outprice every other housing bond that was in the market, both that week and the week before and frankly the week after. Why did this occur? It frankly was because of a very strong retail book. And Lorraine, if you kind of move to page 18, I hinted at this. The one favorable thing about having higher interest rates is that we've had retail investors, really start to pick up their heads and participate in a very strong way, especially in housing financings, which, as we all know, housing bonds are typically priced at par. They're very attractive to retail investors. So we initially offered the bonds only to retail investors. We were more than 100% subscribed, meaning that retail investors came in and agreed to buy all of the bonds that we were offering on a retail basis. Obviously, that set us up, Lorraine, if you go to the next page, very favorably for the institutional order period, meaning that we were able to adjust yields both before we went into the retail order period because of that very strong market that we had the day before on Tuesday when we were doing our pre-marketing. So we adjusted yields downward, lower. At the start of the retail order period, you can see here in the middle of the page, we then adjusted yields downward yet again before we offered the bonds to institutions, 5 to as much as 20 basis points, you can see there. We took institutional orders. Those were also very robust. And at the end of the day, you can see on the far right-hand side, just a great outcome for CHFA in terms of being able to, lower interest rates after the institutional order period. Basically, every single time we revisited this, we were able to lower rates. And, back to that heat map chart at the beginning, you guys hit the market at honestly the perfect time because the market did sell off the very next day. We were in the market this week with another issue, frankly, and treasuries were, hitting their kind of, I call it 16, 17 year highs just earlier this week. So timing was very good. I credit the strong retail book for setting us up. The smaller size of the offering also helped. I will touch on, I know that the board has had some questions about the value of sustainability bonds. Obviously, given the retail nature of this transaction, it was hard to say that, any definitive investors came in because they were labeled sustainability bonds. But I know in talking to our desk that they feel that, frankly, it is definitely additive, meaning that, if we can get 1, 2, 3, more orders added to the book, that sets us up in a better way to be able to make these price adjustments. We will figure that with, I would call these price adjustments very heavy-handed. 20 basis points is a huge adjustment for somebody who came into the deal, the day prior. That said, when you have a very strong book, as we had here, having those buyers in who may be sustainability buyers, certainly helps set us up for to be able to make those adjustments. So hopefully that covered a lot of the high points, but I'd certainly be happy to address any questions that anybody has. But again, your timing was fantastic, and it was a great credit to CHFA that it was 100% subscribed on a retail basis.
Any questions?
I had a question. Is there a difference between the retail and institutional buyers and their interest in sustainability bonds?
That's a good question. It's hard to say. Retail buyers, unfortunately, very rarely, because they're going through brokers. It's hard to know if Hazim were buying for his own personal account. I don't know that he would tell his broker, "Hey, I like the fact that this is a sustainability bond." Versus we will see on the institutional side that a fund group, for example, would say, "Hey, yes, we are buying this for our ESG portfolio," and oftentimes we'll know that fact. So it's hard to evaluate. But I mean, back to my original premise, I feel like housing bonds are naturally ESG. And being able to offer those to retail, I mean, I'm confident that there are indeed retail investors where that, sways them, and they're like, "Hey, I could buy this bond, or I could buy this sustainability bond, and I want to invest in a sustainability bond." So I think it's a net plus.
So Nick, though, on that, if I may, on that question, is there any demonstrable benefit that will show up in how we perform in spreads on the sustainability label?
Yeah, it's a good question, Jerry. I mean, I could forward you. We obviously track this very closely, just to and I think the market is, I won't say desperate, but would love definitive proof where when there are issues where you're offering so-called brown bonds versus green bonds, and if there is a pricing differential between a identical credit offered on the same day and so forth, and you can show that there are pricing differences. We do have a group at Wells that tracks this very closely. I can send you the report, but the conclusion recently is that yes, there is in fact a demonstrable yield spread between sustainable bonds and non-sustainable bonds, if you will. It's just very hard because there are very few, like in CHFA's case, 100% of the debt was sustainable, and it's very hard to say, hey, where would it have traded if it didn't have that label? But I think I forwarded the report to Hazim earlier, and we can make sure you get it.
Yeah, I don't need it. I mean, that's so. I mean, maybe there is, but it is probably really not much, right?
Yeah, no, we're talking. I think they concluded that obviously the muni market's a very small part of the fixed income markets, and
yeah,
the European community has been much more aggressive in terms of rewarding sustainability bonds. But I think the conclusion of the report that we put out was that the net fixed income benefit of sustainability bonds was empirically evaluated as 3.5 basis points over the last year.
Thank you.
Not to open up a can of worms, but on the pension investment side, there's a lot of anti-ESG. There's some states that don't want their pension investment managers to take ESG into consideration. Of course, that's a taxable market, but is any of that anti-ESG impacting the muni market? Where investors may say, I know this is crazy, but if a bond has an ESG label, that somehow that they won't buy it?
Yeah, it's again a good loaded question. But we have not seen that as of yet in the muni market. I think the good news is that pension funds in general have not been big buyers of housing bonds per se, so it probably ripples more into the taxable space than the tax exempt markets, but yeah, nothing would surprise me these days.
Yeah, I would think it wouldn't ripple in too much because they don't buy tax exempt bonds, so they're just not,
Exactly.
any other questions? On to financial reports with Allison Murphy.
Good morning, all. Before you are the September financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 13.9 million above budget for the current year and 36.9 million higher than last year. The revenue variances continue to be driven by an increase in interest rates on the authority's short-term investments. Bond interest expense is 0.9 million below budget through September and 24.7 million higher than prior year. We continue to see the same drivers behind these variances. Our outstanding bonds are higher than the same time last year by specifically $252 million. And interest rates on the authority's variable rate bonds have also increased compared to the same time last year. Servicer fees are 4.1 million above budget year to date and 6.1 million higher than last year. And as we had just discussed, a lot of this is due to our significant increase in our single family loan production. Administrative expenses are coming in 5.1 million below budget and 2 million higher than last year. When you exclude salaries and benefits of 21.7 million, our current year expenses are 284,000 higher than last year. And lastly, our change in net position is above target by 18.6 million. Are there any questions?
All good news.
Mm-hmm.
If there's no questions, let's go on to production and delinquency report. John Chilson.
Good morning. For the month of September, the authority purchased 287 loans totaling $71.8 million, of which 237 loans totaling $57.7 million were securitized, or 83% of September's volume. The remaining 50 loans totaling $14.1 million were whole loans. The average loan size was $250,200. The September month-end mortgage-backed security balance was $2.4 billion, which is an increase of $40.6 million over August. And the whole loan portfolio through August declined by 3 loans. However, the dollar value of the portfolio increased by $5.2 million with a net portfolio balance of $1.1 billion. The combined delinquency rate of the two portfolios was 1.6%. The carrying balance of loans in foreclosure year over year declined by $10.3 million to $13.7 million, while the total loans in foreclosure decreased by 88. And in the month of September, the authority also funded 303 down payment assistance loans totaling $5 million with an average loan size of $16,400. The authority also funded 256 time to own forgivable loans totaling $7.8 million with an average loan size of $30,300. There were 8 new multifamily loan closings in September, increasing the overall portfolio by 7 loans to 568 loans totaling $1.34 billion. Permanent loan delinquencies from the multifamily portfolio increased by 6 to a total of 13, while the construction loan delinquency remained unchanged at 1. The combined delinquency rate
You went on mute.
Thank
Sorry
you for
about
saying that. Because I say, what's wrong with my computer?
We were on combined delinquency rate, I think.
Okay, for single family or combined for a multifamily?
I don't know.
Did you hear multifamily?
I don't know.
All right. So I'll start midway and you tell me if you've heard this already. So the combined delinquency rate before the single family portfolio was 1.6%. The carrying balance of loans in foreclosure year over year decreased by $10.3 million to $13.7 million, while the total number of loans foreclosures decreased by 88. For the month of September, the authority also funded 303 down payment assistance loans totaling $5 million with an average loan size of $16,400. Authority also funded 256 time to own forgivable loans totaling $7.8 million with an average loan size of $30,300. And for the multifamily portfolio, there were 8 new loan closings, increased the total number of loans in the portfolio by a net of 7 to 568, with a portfolio balance of $1.34 billion. There were 6 new permanent loan delinquencies, coming up to a total of 13 permanent loan delinquencies, and the construction loan delinquencies were unchanged at 1. The overall delinquency rate for the multifamily portfolio was less than 1%. Any questions?
I have one, because I can't find my hand. There you go. I saw that delinquencies went up by 6 in multifamily delinquency. What was it in the regular residential, the single family?
For single family, it was 1.6.
No, but did it go up? Did it go down?
It went down 2 basis points.
Okay, because that's as of when? September, or forget what date? What's the timing on that? As of the end of which month?
Okay, so the decline in the single family portfolio was a month over month, and the increase in the multifamily was also month over month.
Okay, because the industry study for the first time in a long time is show an increase in the single family, so that's why I was asking.
Yeah,
not a big increase, but we saw the first increase in delinquencies in a long time.
Our overall expectation is eventually delinquency rate will start to climb. It's as you know, really at historic lows right now, and the primary reason for that is that throughout the pandemic, HUD, along with Fannie Mae and Freddie Mac, offered very generous loan modification opportunities for borrowers, and plus we had other federal programs like the HAF program that really greatly declined the overall delinquency rate. But the expectation is that a lot of that won't hold, that there will be redefaults, and we will see the rates rise above these historic lows.
I agree with what you're saying. The only thing I would add that also banks in general, financial institutions in general, also offer very attractive, modifications and or other assistance to consumers besides HUD and the other federal regulators.
Right.
Okay.
Any other questions? If not, we'll go to the investment and swap report. Allison Murphy.
Before you are the swap valuation and investment reports. The third quarter of the year, we experienced a net increase in the book value of our investments by approximately $28.5 million to $3.7 billion, and an increase in the value of our program assets by $73.4 million to $2.4 billion. During the quarter, the weighted yield to maturity increased from 3.78% to 3.93%. There was no change in the number of counterparties or number of contracts in our swap portfolio from last quarter, remaining at 42 swaps with 8 counterparties, with a notional balance of $936 million. The quarter-over-quarter weighted average pay rate remained unchanged at 2.992%. We also saw an increase in the market value of our swap portfolio from last quarter, with this past quarter increasing by $44 million to $69 million. There is a direct correlation between the changes in interest rates in the value of our swap portfolio. As interest rates go up, the market values of our portfolio increases. With the cessation of LIBOR back on June 30th, beginning July 1st, 1 month LIBOR now means compounded overnight SOFR rate over 1 month plus 11.448 basis points. And 3 month LIBOR now means compounded overnight SOFR rate over 3 months plus 26.161 basis points. I'm happy to answer any questions.
Any questions on that? That's interesting to see how that's working with the LIBOR. So they take SOFR and then they determine the spread, but that's determined by Bloomberg every month or every day?
Daily.
Okay. Any other questions? Next item is the approval of the minutes of the Finance and Audit Committee meeting of September 28th. May I have a motion?
I move it. This is George.
Second?
I'll second Chelsea.
Thank you, Chelsea. Any corrections or discussion?
Hey, Sarah, I have a question. I wasn't here. I have no objections to the minutes. Is it just standard practice to abstain, or I'm still allowed to vote aye? Or I don't know if anyone knows the answer to that.
You can vote on that, Jerry.
Okay.
Okay,
Thank you, Teresa.
different boards treat that differently, but that's fine. Let's see. With that, okay, we have a motion, we have a second, right? Roll call vote.
Jerry Abrahams,
Aye.
Commissioner Dahm,
Aye.
Phil DeFranco,
Aye.
Catherine McKinnon,
Aye.
Chelsea Ross,
Yes.
Sarah Sanders.
Aye.
I'm so sorry. Commissioner Perez.
Yes.
Thank you. The vote passes unanimously.
Okay, anything else people want to talk about or suggest for future meetings? Very good. Well, thank you, everyone, and we'll see you at the board meeting.
Thank you.
Adjourned.
Thank you.
Here.
Thanks.